Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. In today's video, I'm going to showcase primarily Federal Express, air freight and logistics company we're all familiar with, and I am going to contrast it to UPS. But the actual featured stock for today is Federal Express because I think the company has become very attractively valued here recently. And, the idea is, and I'll get into this more in the video, you want to buy low and sell high, or as Warren Buffett said, be greedy when others are fearful and fearful when others are greedy, because as I always say, you make your money on the buy side. But there's another principle of investing that I think I take for granted sometimes when I'm doing videos like this, that I want to really showcase also in today's video. And that's the idea that earnings determine market price in the long run. Okay, that's an extremely important principle and a foundational principle of my own personal investment strategy and beliefs as a long-term value investor who believes in buying and holding stocks for the long term, but only buying them when they're attractively valued, and really preferring to only buy them when you can get a good margin of safety. And in a very highly inflated market like we have today, that's very, very difficult to do. But I think there's another important thing that I want to point out relates to EDMP, or earnings determine market price in the long run, but there's an evil twin sister that says emotions determine market price in the short run. And I really believe that's a distinction that many investors either just aren't aware of or they simply don't logically make when they're thinking about their investments. We have to recognize that the stock market is not always efficient, as some academics would like to lead us to believe. On the other hand, I would say the market is always seeking efficiency. In other words, in the long run, that's why earnings determine market price. When stocks get disconnected from intrinsic value, inevitably they'll move back into intrinsic value. I talk about that all the time. And I also point out that it's a market of stocks and not a stock market. So even in a highly inflated market like we have today, there are stocks, and I think Federal Express is a good example, that is attractively valued today. And by the way, its, brethren, if you will, United Parcels or UPS is coming into fair value. It's been an overvalued stock here recently that's now coming into value. So let's go ahead and get into the video here, and let's turn to FastGraphs, and let's start by looking at Federal Express. Now, what I've got on the graph here, FedEx earnings per share plotted going back to the beginning of their fiscal year, which is May. So I go from May 2001, and then I've got some estimate data out here through May of 2005. And I do want you to see the distinction. This light green shaded area where things get dashy here, if you will, that's forecast. Everything in the dark orange or dark green area is history, or what I would call actual results. And the actuals, and we learn from history, but we also invest in the future. That's why we have both things listed here simultaneously on the graph. Now, this orange line represents a version of discounted cash flow analysis that suggests that the fair value multiple for Federal Express is 15 times earnings. So this orange line is a PE of 15. You can see anywhere time I point to one of these triangles on the orange line, it shows that that's a PE of 15. So that simply says if the price is touching that, it's fairly valued. If it's below that, it's undervalued. And if it's above that, it's overvalued. But the other thing is, what I want you to kind of note here is, how realistic is that? How does it really work in the real world? That's an interesting theory that we've applied this modified formula, Graham-Dodd formula, to calculate this 15 PE, because the company has a historical earnings growth rate of 11.22%, including the estimate data I have in here, by the way. So that's not just pure historical growth. And that's also important. Now, some of the other things I want you to understand is this light green shaded area represents the dividends. Dividends are paid out of earnings, okay, or cash flows. All right, so now I've plotted this white line on the graph, and this plots dividends per share. Now, I want you to note that the dividend payout ratio, which is this area below the white line, for Federal Express has been very low. It's been single digits, for all these years back here. Starting in 2017, their dividend payout ratio increased to 13%. Then it increased to 17% in 2019. In 2020, it was around 14%. But keep in mind, that calculation of it got up to 27% in 2020, but that 27% was also related to the fact that we had this drop in earnings due to COVID. But then, of course, we've had this strong recovery. So we're looking at future payout ratios to be around, in the 14 or 15% range. Okay, but the point is this pays out a very small portion of its earnings and dividends. Now, here's the thing, and this is what I really want to get your full attention on. If it is true, as I stated earlier, that earnings determine market price, if I overlay monthly closing stock prices on this graph, then if my theory or if the theorem is correct, the price should follow this orange line. So let's go ahead and test that. Let's put the stock price on the graph. And what we see here is a very, very high correlation between the stock price. These are weekly closing stock price on the soon-to-be released new version of Fast Graphs to the company's earnings. Now, we also see those disconnects I talked about. We see periods where the price gets far above the 15 PE. In this case, we're looking at 20-ish PEs, but then it eventually reverts back to close to a 15 PE. Going through the Great Recession, it traded at a 15 PE or lower for a few years, but we also had a dip in earnings during that time frame. But I do want you to also note that the dividend increased. It went from 36 cents in 07 to 40 cents in 08 to 44 cents in 09. It stayed the same at 44 cents in 2010 and then started growing again in 2011 and going forward. But this is not so much a dividend payer as it is but it is a dividend growth stock from the point of view that the dividend grows. But I think it's also a growth stock. It's had double-digit earnings growth for all that time. Now, we saw, pretty good overvaluation in 2014, and then it came back into fair value. And my point is, anytime I can buy it when the stock price is touching the orange line or below the orange line, that would be the optimum time to buy the stock, because what happens when you do that, and this is the whole point of value investing, is you participate or you position yourself to participate in the performance that the business generates on your behalf. If you overpay, the business can perform beautifully and you can get a lower rate of return than what the business generated in terms of earnings and dividend growth because you overpaid. Now, in contrast, if you get a chance to underpay, you can get a slight premium to that growth. That's what makes earnings growth so important. Now, I did have a subscriber. It goes by Thor SCH, and I'm not sure if that's just an FCH is an abbreviation or that's actually his name. But he did ask me a question, and I want to use this opportunity to answer that question. He said on my last video, the one I did yesterday, "Thank you for the video. Looking at some of those chart rockets, I wondered about the relationship of PE and growth. If I take the earnings yield and pretend it would go 100% into share buybacks, then it would generate earnings per share growth. This way I could compare it directly to the organic earnings growth." Well, I don't think you need to do that. I think you really need to just estimate the earnings growth, which I'll show you here in a moment. So he said there should be a formula which can clearly state what is better: X, a PE ratio with Y growth, or Z PE ratio with D growth. And the point is this that I want to get across. The PE ratio at the time, currently FedEx trades at 11.67 times earnings. 15 would be the fair value PE. So I consider the fair value of FedEx currently at something around $300 a share based on a 15 PE times next year's earnings, which are in May. The stock currently trades at $219. You can see that the price is below the orange line. So this gives me the margin of safety that, if the stock moves back into fair value, like I think it probably will eventually, maybe not exactly at that point, then I got a chance to make a very substantial rate of return, significantly greater than the actual earnings growth rate. Okay, because earnings yield of the company right now is 8.57%. I like at least the 6.5 to 7, which, by the way, is the inverse of a 15 PE ratio. 6.67% is what a 15 PE ratio represents in terms of earnings yield. An 11.67 PE ratio like we have now gives me an 8.5% almost 6% earnings yield, which is a very strong advantage. Now, the dividend yield is 1.25%, which is actually a pretty good dividend yield for this particular company because, as I stated, it's not really a dividend stock as much as it is a capital appreciation stock. But the company is forecast to give us nice growth in the next 3 years. And the fact that you can buy it at such a low current valuation suggests to me that this could be a great opportunity. I also want to make another point here. Trying to hit the perfect top or perfect bottom when you're buying or selling is virtually impossible other than by chance or luck. Okay, we all need to wear that. They don't ring a bell at the top of a market, nor do they ring a bell at the bottom of a market. But if you're interested in trying to hit the bottom, then common sense would suggest you want to be, your best chance of doing that is during a time when the stock is dropping. If you start buying the stock after it's been rising, like say back here, in July of 2020 when it rose to 165 from a low of 123, odds are you're not going to hit the bottom. Now, I'm not saying you're going to hit the bottom if you buy it here. I'm just saying you have a chance to do it, where if you wait till the stock starts to rise, you have less of a chance to hit the very bottom. The corollary to that, or the flip side to that, is if you wait till the stock starts rising and give it some time to see some, appreciation where you might see sentiment starting to change, you probably have a better chance of not seeing the investment go lower after you buy it. All right. So those are, realities of investing that I think you need to take into consideration. The next line I want to put on the graph is what I call the market value line, or we call it the normal PE ratio, which simply is a trimmed average of how the market has normally valued the stock. Now, this is a, triple B rated, high quality FedEx, $59 billion market cap company. And, it's obviously a very high quality company. And the market does have a tendency to put a little premium valuation. So this 15 to 17 times earnings kind of creates what I would call a valuation corridor. The 17, or the blue line, is the high-end valuation. The orange line is the fair value, but not necessarily the low point. Low point would be something below that, like we're seeing today. But the point is, that's a range of reasonableness that allows you to pretty much participate in what the company does. Now, when I look at this from a performance point of view, and I'm going to go to the current version of FastGraphs because that's one thing we don't have working fully yet, is the actual we have an accurate performance comparison on the new version, but we don't have the accurate comparison to the S&P loaded yet. But if I look at FedEx going back from December 29th, 2000 to yesterday's close, a $10,000 investment would have thrown off as much income just short of the S&P 500 over this time frame. But I also want you to note that the dividend income grew dramatically over that period of time. The dividend grew by an average of 15%, 16.2% on average, compound average 15.3%. But we didn't get any dividend growth for the last couple of years, and that's, related to the fact that we've had some weakened earnings going on here, but also note how the stock price tracked that. So I think that's very important. But the point is, this ended up giving us a 9% annualized rate of return. It's actually outproduced the stock market on total return, turned 10,000 into 55,000 versus 34,000. But once again, I want to remind you that that's measuring it when the valuation is low relative to the S&P 500, which is trading at something north of 25. I think it's almost 28 times earnings. All right. So the point is, I always say measuring performance without simultaneously measuring valuation is a job half done. I'm really measuring the performance of this company at a disadvantage because the company is undervalued today, trading for less than its earnings growth would suggest. Okay, but I want to go back to Thor's question here, and I want to go to forecasting here because I want you to really see how this works. The estimated growth rate, now there are 27 analysts giving me estimates for the next 2 years. And remember, this company has a May fiscal year. So this is for May of 2022 to May of 2023. That's about as far as I like to go. Now, in this particular case, we still have 10 analysts willing to give a forecast all the way out to 24. But notice we dropped down to 2 analysts that are willing to give us a forecast out to 2025. The further out you go, the less likely, you are to have the estimates being close to being accurate. They're not going to be perfect anyway, but hopefully they're reasonable. But here's the point. If I buy this stock today at a blended PE of 11.67, that's down here, and I get 10.07% growth like I'm expected to, and earnings go from $18.17 last year to $20 estimated this year. And by the way, I might point out that the earnings estimates here have been vacillating. They went from 19.5 6 months ago. Then they were expected to be $21.33 3 months ago, and now they're back down to $20. So that's gone down a little bit in terms of consensus. Now, the same is true of the 2023 estimate, where it was expected to be 12.5% is what we're currently expecting. It was expected to be 21.50. Then they increased it to 23.70 3 months ago, and then 22.50 currently. But these estimates are pretty reasonable. If we check the analyst scorecard real quick on FedEx, the company does hit estimates or beat estimates most of the time. On the 1 year forward, they've done it, they've missed 38% of the time, and on the 2 year, 31% of the time. And of course, a lot of that had to do with the numbers coming in during the COVID pandemic, especially, were negative for the last couple of years in a row. So you also want to take those things into consideration. But let me go back to Thor's question now. I've got earnings growth on average going all the way out to 2025 of 10.68%. I've got a low valuation, so I got the opportunity for the PE to go from 11.87 today to 15 times earnings by May 31st, 2023, which I think would be rational, reasonable, and highly probable to at least get to 15 times earnings. That would give me a 31% annualized rate of return. So the earnings yield gives you the current earnings yield, but it does not suggest what your rate of return is going to be. You have to couple that with what the valuation level is, plus the growth expectation of the company going forward. So I hope that clarified things a little bit, for Thor. Now, I did tell you I was going to contrast this to UPS. Now, UPS is quite a bit different. I've only got 7% growth here. I've got a 2.09% dividend yield. The market has given this company, normally valued this company somewhere around a 20 PE or higher. You can see back, between the recessions here, it was even trading as high as 27 times earnings. So that's a tendency that the market likes to put a premium valuation on this company. But we still see a very strong correlation between earnings and market price. Now, another thing I want to point out, if I do UPS's performance and compare that to what I have here with FedEx, where I got 9%, with a $4,500 dividend on a $10,000 investment. Over that same time frame, UPS threw off more dividend income, significantly more than the market, but it gave me a lower capital appreciation than both the S&P or FedEx. So I ended up with 6.7% instead of 9% with UPS. And the reasons for that should be obvious. Number one is the stock was really heavily valued. So I did not get the full benefit of the 7% growth of the company going forward. In addition to that, the PE ratio when I bought it here would have been 25. The PE ratio at the end here is 17.1. So I've had PE ratio contraction. And that's why my rate of return, my capital appreciation, is actually lower. I only got 5.6% capital appreciation, which is less, and I want to emphasize that, less than the 7.2% growth that the company generated, because I went from a higher multiple evaluation to a lower multiple valuation. And as a result of overpaying for the stock, if you will, back here, or it was too fully valued, I ended up getting less than what the company delivered. Now, the dividend did contribute to the return and got me pretty close to the 7.2% growth, but then, I should be looking at 8 or 9% if I'd have bought the stock at fair value, or if I could have bought the stock at fair value. In fact, if I go here and look in during the Great Recession and buy that when the PE was 12, notwithstanding we had, a little bit of continued earnings weakness, my rate of return would go up to 14%. That's where valuation matters, and it matters a lot. But UPS is also a very interesting air freight and logistics company. Now, I ran both of these companies. I looked at both of these companies through Morningstar, and Morningstar points out that FedEx and UPS are the major U.S. incumbents. And then they also say, well, DHL Express leads Europe. They also illustrate that FedEx is also the largest U.S. less than truckload carrier, And according to Morningstar, that helps them forge sticky relationships with retail and industrial shippers on the package side. Rival UPS has been around a lot much longer in the U.S. ground market, and therefore they forged a density advantage and higher margins. And I'll show you that here in a moment. But FedEx has gradually enhanced its ground positioning over the past decade, which actually helps from its speed advantage over UPS and their measured capacity investment. So according to Morningstar, in our view, FedEx's flagship express and ground package delivery operations enjoy significant competitive advantage rooted in cost advantage and efficient scale, which allows them to give FedEx a narrow moat. And they go on to say FedEx is capable of keeping would-be competitors at bay for a prolonged period. But nonetheless, they say, despite lofty entry barriers in global parcel shipping, we constrained FedEx moat to narrow rather than wide because we expect the firm to out-earn its cost of capital by only a slim margin. In contrast, when they talked about UPS, Morningstar pointed out that UPS has also boosted its exposure to the asset-light third-party freight brokerage market, especially with its recent 2016 acquisition of truckload carrier Coyote Logistics. But they also point out that the firm divested its LTL trucking division, UPS Freight, in the second quarter of 2021 as part of CEO Carol Tome's better, not bigger framework. So, Carol's going for better, not bigger. But despite its unionized workforce, which is a disadvantage from a standpoint of cost of employees and asset intensity, UPS produces operating margins well above competitors, thanks in large part to its leading package density. It's been around much longer than FedEx in the ground market. And in the United States, FedEx Express and ground units together handled about 14.4 million average parcels daily, while UPS moved 21.1 million in calendar 2020. So, UPS does move more merchandise, but they actually are a slower growing company. Now, going into fun graphs here a little bit, I want to take a look at some of the things that I talked about here. Let's go into the ratios graph and let's look at some of these profitability ratios. The first I want to look at is gross and net margin. I'm doing this for the last 10 years. You can see that FedEx's gross margins are, remain in the 20% up into the 22, 23% range, and they bring somewhere around 5 to 6% to the bottom line. Now, during COVID, their margins got very thin, but they have recovered back to about 6% here recently. If I can contrast that to UPS, which, Morningstar talked about, I could look at margins of UPS, and UPS has, up to 25 margins. But what's interesting is, although they bring about 7 to 8%, net margin down to the bottom line, their margin here recently in the most recent quarter has actually dropped down to, their net margin is down to only 1.5%, but perhaps, they can fix that. Now, other ratios that are real important while I'm in here, to be return on invested capital. UPS generates around 21, to 25% returns on invested capital in recent years. In contrast, if I check that against FedEx earns about 16% on the high side down to 5 and 8% on the lower side. So from a profitability ratios, UPS does have an advantage. From a growth advantage, FedEx has been, the clear leader. Now, looking at some other important statistics, if I go into the income statement and look at shares outstanding, FedEx has been reducing their share count ever so slightly through 2014, 15, and 16, and the stock was reasonably valued. UPS, in contrast, has a very similar record of reducing their share count a little bit, but I don't like the way UPS did it in terms of valuation. Now, I can also go into things like the balance sheet and look at, I'll go in, before I go into the balance sheet, before I leave the income statement, I wanted to point out that, revenues have grown very nicely in UPS. I don't have the calculation of the growth rate on here yet, but I will soon have that before we launch the new version. But, they went from, in millions here, they went from 53 million in revenues up to 84 million in revenues, where if I look at FedEx through the same lens, FedEx revenues went from 39 to 84. So, the reality of it is both of these companies have good revenue growth. From the balance sheet point of view, both of them have seen good growth in total assets. Their total debt is reasonable in both cases compared to their long-term debt. Now, I would go through, with the videos getting long, so I'm not going to do it. I would go through all these things on the balance sheet. I would look at, their cash and short-term items. I would like, I'd run a company when I'm doing research like this. I try to run a company through all of the, aspects that can give me, confidence. FedEx is currently running, about $7 million in cash on the balance sheet. I think that's good. We can look at UPS here. I would go ahead and look at that later. But the point I want to get at is when it comes down to an investment decision, although UPS is a great company, the market does put a premium value on it, which makes it hard to buy. FedEx has become very attractively valued here recently. And I think given its growth potential would be my choice in the air freight and logistics sector right now. UPS, however, is one that I'm watching and that I would watch because I like both of these companies very much. And as you can see, we've started to see UPS here recently moving back into alignment. Now, they have a December fiscal year. So, a good time to have bought UPS would have been back here. This would have been a good time to buy UPS. I do believe buying value is very, very important for your long-term needs. Anyway, this has been Chuck Carnevale featuring FedEx today. I like it. I think it's become, very attractively valued here recently. I think it's a, really good company that can be purchased at a very attractive valuation today. If you like this video, if you thought the video was a good video, then, please ring the bell, give me a like, and, do all the other things that, that help us grow this channel so we can help more investors. Also, of course, if you haven't subscribed, please subscribe. And by the way, you might want to take a hard look at the FastGraphs Fundamentals Analyzer research tool. Also, I couldn't even consider investing without it. It allows me to, especially, to look at a company from the fundamental perspective, the earnings, the cash flows, the dividends, etc., and get some really good perspective before I waste a whole lot of time researching a stock that may be overvalued that I would turn out not to buy. FastGraphs just makes it so much easier and so much quicker to really dig under the hood and look at the fundamental values of the company. Thanks for watching.